Everybody hates capital gains, whether it's for crypto or for even just the plain old stock market. Today, I'm going to show you how to save money on your crypto taxes or really any capital gains tax. And crypto has a few loopholes that allow you to do this a lot easier than traditional finance like stocks and ETFs. Today, I'm going to give you two main tips. Stay till the end because the second one is basically one click and can save you potentially thousands on your taxes. So no, this is not clickbait. If you are in the correct situation, you can do what I'm going to show you in this video and save up to $1,000 on your taxes at the end of the year. Especially now where the crypto markets, mostly altcoins, are down, this is the perfect opportunity to get into tax loss harvesting. A lot of you probably are familiar with tax loss harvesting, but it's a little different when it comes to crypto, and it's actually easier. So tax loss harvesting works where if you have a position that's down, using round numbers, let's say it's down $10,000, and you sell that position, now all of a sudden you have a $10,000 capital loss. And what that means is at the end of the year, when you file your taxes, assuming you had no other capital gains, then you can take $3,000 of those capital losses and basically offset your normal income from your job, or in this channel from crypto mining. 3,000 is the cap that you can use against your actual income. But let's say you had 8,000 in capital gains that year and 10,000 in capital losses. Well, now you have 2,000 in capital losses and you don't have to pay any money on those cap gains. So obviously, you don't really want to be down $10,000 on any position, but when you're holding long term, especially in crypto, there's a lot of opportunities where coins just are down, and that's why you want to take advantage of it. Another important thing to remember is that capital losses you can carry over from year to year. So if you had 30,000 in capital losses, you could technically carry that over for 10 years and offset 3,000 from your income every single year, assuming you had no cap gains to offset that throughout that 10-year period, which hopefully you do have some capital gains in that period. So let's talk about why crypto is different, because tax loss harvesting is normally applied to traditional finance, but there's rules to kind of combat how effective it is, and that rule is called a wash sale. So if you don't know what a wash sale is, it can really kind of bite you, and this happened to me when I first got into investing. But a wash sale is if you sell an asset for a $10,000 capital loss, and if you buy that same asset or a very similar asset within a 30-day period after that, then your capital loss is gone. You can no longer use it because that's called a wash sale. You bought an asset that you just sold for a loss within that 30-day period, and that's a wash sale, so you can't use that capital loss anymore. But it goes even further. You also cannot buy that same asset 30 days in advance. So there's basically a 60-day window between where you sell your capital loss right here that you cannot buy that same asset. So for stocks, that kind of sucks because say you have QQQ and you're at a $10,000 loss. I don't know how because it's been going straight up, but if you were, and you sell that planning to buy back in a month, so you can basically lock in that capital loss but still have the same position within the ETF. Well, if QQQ goes on a 60% run in that month, well, now you're buying back in basically significantly less shares than you had before. But you didn't do a wash sale, so you still have your capital loss of 10,000 at least. Now, this is where crypto comes in, that it's in a whole different ballgame, and tax loss harvesting is extremely easy. Crypto does not have wash sales, and I'll pop it up on screen right now, but as of today in the United States, there is no wash sales in crypto. So you can sell 30,000 in capital losses and the same day buy those exact same coins back, and you still have your same position, but now you've locked in 30K of losses that you can offset all your gains from that year, from next year. And just to clarify something, let's say you carry over 30,000 in capital losses to next year. You're not limited to only using the 3K for that year. If you had 20K in gains that year and you carried over 30K in losses, that means that you can write off all the gains So now you just have 10,000 in capital losses, and then you can apply 3,000 of that to your income, and then you carry over 7,000 over to the next year. So let's take a look at a quick example of what a tax loss harvesting sale would look like and how I could apply this to my portfolio. That if you guys are subscribed to the channel, we look at my portfolio very often, so you guys will be familiar with this. So my portfolio right here, $4,150 worth since I started mining at the beginning of this year. And the total profit loss is minus $2,150. Not great. But where that comes from is almost all in Neoxa. I'm down 50% on my Neoxa investment. I bought $1 million for a Neoxa node. Check out this video if you haven't seen that and the benefits of it. Even though the price is down, now would be a good time to buy one. But you can see that I'm down almost $2,000 basically on my Neoxa. So now would be a great time for me to sell my 1 million Neoxa and buy it back the next day or even the same day, and then put it back into the node. And then I've locked in $1,600 in capital losses to apply to my taxes this year. And also I still have my node that's generating all this money for me. So let's talk about the downsides of why I haven't personally done this with Neoxa. And the main thing comes down to liquidity. Neoxa on TradeOgre at least does not have enough liquidity for me to just hit the sell button and sell 1 million Neoxa and buy back 1 million Neoxa without significantly affecting the price. Basically, when I sold 1 million, it would constantly be dropping the price, so I'd be getting less and less the more Neoxa I sold. And then when I started buying back my 1 million Neoxa, the price would be going up and I would be getting less and less. So if I did that, I may only end up with 900,000 Neoxa. But if you have Bitcoin or Ethereum or some of these much more liquid cryptos or stocks, with stocks you really don't have this liquidity issue, but you can't do it same day because of the wash sales. But if you had Bitcoin or Ethereum, then you could do this in the same day without issue. Now, the second reason I haven't done this on my Neoxa holdings is because they're locked into a node right now. And I'm just a bit lazy and don't want to deal with getting all that out of the node, selling it, buying it, and then putting it back into the node. If the liquidity problem wasn't there, then I probably would do this because $1,600 is a lot to be able to write off. That would be very helpful at the end of the year. Crypto tax tip number 2, and similar to the last one, this also applies to any capital gains from stocks and ETFs as well. And this tip is in regards to your cost basis method that's being used in either your broker for stocks or your crypto tax software for crypto. So I highly recommend Koinly. I tried to reach out to get them to sponsor this video. They were not interested, so I'm still going to recommend it anyway because I do really like Koinly. But cost-based method is basically when you sell a stock or a crypto, what stock or crypto are you actually selling? Because if you have 10 different purchases and you sell one, are you selling this one? Are you selling this one? Are you selling this one? Which stock or coin are you selling? Because they're all different lots basically. And the way you set this up can make a huge difference in how much taxes you owe at the end of the year, especially if you're only selling a portion of your holdings and not the full position. So let's talk about the different options. You have FIFO, F-I-F-O, first in, first out, which is if you bought 10 Bitcoins, 1 Bitcoin here, 1 Bitcoin here. First in, first out would be when you sold this 1 Bitcoin, it's taking the first one that you bought and it's selling that one because it's the first in, so it's the first out. Now, this is probably the worst one that you could use because let's say you bought Bitcoin at $10,000 on your first purchase, and on your last purchase, you bought Bitcoin for $100,000. And when you sell Bitcoin, it's worth $100,000. So with first in, first out, your first Bitcoin you bought for $10,000. So when you sell it for 100K, that's $90,000 in capital gains at the end of the year that you're going to have to pay either short-term or long-term capital gains tax on. Let's look at last in, first out. So that's another option, LIFO. And last in, first out would be the same situation as last time where your first Bitcoin was bought at 10K and your last was bought at 100K. So last in, first out would mean when we sell this one for 100K, we're taking the last one that we bought, which was worth 100K. So you sell that one and now your capital gains is 0. You have to pay 0 tax on that Bitcoin that you sold, and you still have your other Bitcoin that you bought at an earlier time. So that sounds like a good method, but there's actually an even better one. And most brokerages and tax software will have it. It's called HIFO, highest in, first out. So using the same analogy one last time, you sell Bitcoin for 100K, you have all your purchases over here. We established that the last one in we bought for 100K, but what if the one before that we bought for 120K and Bitcoin's just gone down a little bit? So in that situation, when we sell one Bitcoin for 100K, it's going to sell our highest cost basis Bitcoin, which is that one we bought for 120K. So that one gets sold. And what happens is now you have $20,000 in capital losses that you get to write off on your taxes and carry over $17,000 into the next year. So you always want to use highest in, first out as the cost basis method in any stock or crypto software that you are using. It's a one-click button and it can save you a ton of money. Now, this really only applies to if you're selling a portion of your position. If you're gonna sell every Bitcoin you own, then it makes no difference which option you use. But if you're gonna sell just one Bitcoin to buy a car or one stock to switch to another stock, you're not selling your whole position. That's where cost basis method really comes into play, and I recommend doing it to reduce your taxes. Just as an example, I'll show you in here on Koinly. If you go into settings, you can see I've got it set to highest in, first out, but you can go into settings here and real quickly, let's see. My capital gains is minus 1,200 for this year with the highest in, first out. Let's see how much it changes if I go into first in, first out, which is normally the default. So it's going to update. It might take a second. We'll let it load for a minute. Okay, it's loaded. Let's go ahead and hit refresh. Not a big difference. Let's see if it changes. Okay, there we go. So basically, I'm saving myself $300 in taxes by using the highest in, first out instead of first in, first out. And it's only June, so it could be $600 by the end of the year. But hopefully we start getting some serious cap gains in that time. I'm Jack from Modern Mining. This is normally a crypto mining channel, but really I'm all about finances and how to maximize your wealth. So subscribe if you like these kind of tips. And if you're interested in learning how to turn an old Dell PC into a Bitcoin miner for less than $200, check out this video.